Chapter 1, the 50% tax increase on IRA distributions. The single most important thing to understand about the U.S. tax code is the difference between gross and taxable income. Let's introduce John and Judy. They have $100,000 of gross income. What do you think their tax bracket is? Most people will see a married couple with $100,000 income and think they're in the 22% bracket, but that's not right. Your federal tax bracket is actually based on your taxable income, not your gross income. Taxable income is a net amount you have after you take the various deductions and or exemptions that are available. So let's assume John and Judy do not itemize their taxes. The only deduction they have is a standard deduction. Under the new tax bill, the Tax Cut and Jobs Act of 2017, taxpayers under 65 years old can take $12,000 in standard deductions. Taxpayers 65 and older have standard deduction of $13,300. So assuming John and Judy are both over 65, they would subtract $26,600 from their $100,000 of gross income. And thus their taxable income would be $73,400, which puts them in the 12% bracket. They will pay $8,426 in federal income tax. But what happens if they add $10,000 by taking a distribution from a traditional IRA? Now their taxable income is $83,400, which does put them in the 22% tax bracket. And now their tax is $10,227, an increase around $1,800. Put another way, that $10,000 distribution accounted for 9.1% of their total income, yet it accounted for 17.6% of their total tax bill. I'm going to show you the table below, and you can see that a $10,000 IRA distribution, how it affected John and Judy's taxes. Now here I'm just going to read the table. All right, so there's no IRA distribution. John and Judy have $100,000 of income. That means they have $100,000 of adjusted gross income. Their standard deduction is $26,600. Their taxable income then is $73,400, and their tax due is $8,400, give or take. Now you add the $100,000. You had a $10,000 IRA distribution to the $100,000 of gross income. Now their AGI, their adjusted gross income, is $110K. You take away the $26,600 in standard deductions, and their taxable income now is $83,400, which puts them as a tax at $10,227. Most taxpayers understand that tax rates go up as income increases. What gets overlooked is that the actual percentage of the increase is huge. In John and Judy's case, it was a 50% increase. How? Because that $10,000 distribution cost them $1,801 in additional tax, meaning their effective tax rate on that distribution was 18.01%. $10,000 distribution, $1,800 in tax, that's 18%, 18.01 to be precise. If they had remained in the 12% tax bracket, though, their tax would have only been $1,200. So $600 more on initially $1,200, that is a 50% increase in taxes on that $10,000 distribution. What would have happened if that $10,000 IRA distribution came from a Roth, though? And here's where it gets exciting, my friends. Roth distributions are tax-free, so that $10,000 will not be included in their taxable calculation. They have the extra $10,000 to spend. They just don't pay tax on it. Now, you might argue, yeah, Josh, but your numbers are sound, but they received a deduction on the money going into the IRA to begin with. You'd have to compare the tax they pay now to the savings they had before. That's 100% correct. Yeah, absolutely. We certainly need to look at the tax savings of the IRA deduction against the tax-free withdrawals of the Roth. Absolutely. However, my experience is that many working taxpayers don't have near the taxable income they think they do, given varying tax deductions and credits, mortgage interest, credits for children, real estate tax, maybe they tithe. In fact, let me ask you, do you know what the number on line 47 of your own 1040 is? Well, that's your total tax. How much of that tax was reduced by your itemized deductions? Be interesting to find out. Unfortunately, most taxpayers actually retire into higher tax brackets because their RMDs, required minimum distributions, put them there, and they no longer have any itemized deductions, which is exactly what happened to John and Judy. At that point, there's not much they can do other than pay the tax. But keep on reading, and you'll see the many other overlooked benefits of the Roth.